Welcome to the deep dive. We're looking at a massive stack of fresh market intelligence today, and we have a very specific mission for you. We're going to navigate this immediate high-velocity market drawdown and examine this looming structural deadline that's about to impact the core security of Bitcoin itself.
Yeah, right now there is this, well, it's a fascinating juxtaposition playing out.
Exactly. I mean, the broader market is just entirely distracted by short-term liquidations, while the federal government just set a ticking clock on the cryptographic foundations of digital assets.
Right, people are heavily focused on the surface level price action, but, the actual bedrock of the network is shifting under our feet.
So let's start with that surface noise. We just saw this sharp downside probe to $61,860. It wiped out over $150 million in leveraged longs.
Yeah, massive wipeout.
But the catalyst wasn't even crypto native. It was driven by a broader tech sector sell-off in traditional equities, specifically AI and semiconductors. So, are we looking at a structural fracture here, or is this just routine algorithmic panic?
I mean, it highlights a massive dichotomy in how different market participants are reacting right now. Traditional finance mechanisms are showing intense caution.
Right, the ETFs.
Exactly. United States spot ETFs like BlackRock's IBIT and Grayscale's GBTC saw $68.3 million in daily outflows. But corporate treasuries are using that exact same panic to actively absorb supply.
Wait, really? Who's buying?
Well, a great example is Hyperscale Data. They're an AI data center provider, and they're using their organic AI hosting revenue to take physical Bitcoin supply right off the market. They're holding over 726 Bitcoin now.
Wow. So the institutions are just quietly vacuuming up what leveraged retail traders are forced to sell.
Yeah, and that institutional reality is triggering structural regulatory shifts. I mean, think back to the geopolitical crisis in February.
Oh, right.
Traditional energy markets were closed for the weekend, so global oil traders simply migrated to the decentralized crypto platform Hyperliquid to hedge their risk. That platform absorbed $1.68 billion in oil volume in a single weekend.
That's insane for one weekend.
It is. And because traditional finance is terrified of losing its global pricing power to these platforms, the CFTC is now exploring 24/7 perpetual contracts for physical commodities.
Okay, let's unpack this. Because if traditional finance adopts these 24/7 crypto trading architectures, they aren't just importing the technology, they're importing crypto-native systemic risks.
Oh, absolutely.
I'm looking at the New York Fed's recent warnings about synthetic stablecoins like USDB. If traditional markets run around the clock using perpetual futures, aren't they exposing themselves to the kind of, automated flash crashes we see in crypto?
Yeah, so the mechanism behind synthetic stablecoins makes them highly reflexive. They maintain their dollar peg not by sitting on physical cash in a bank, but by pairing user collateral with short positions in the perpetual futures market.
Right, okay.
So when markets are bullish, there's a high funding rate, meaning traders betting the price will go up pay a premium to those betting it'll go down. The stablecoin collects that premium.
When a flash crash hits, the spot prices fall, and those funding rates just flip negative.
Spot on. Now, the stablecoin protocol is suddenly forced to pay out to keep its short positions open. And to stop the bleeding, the client automatically forces it to unwind those hedges.
Whoa, wow.
Yeah, it starts dumping physical collateral into an already crashing market, which just accelerates the liquidation cascade further down.
So it's like getting a margin call on an adjustable rate mortgage, but the bank's algorithm automatically liquidates your living room furniture the second the rate flips, forcing neighborhood property values down even faster.
That is the exact systemic vulnerability the Fed is concerned about importing into traditional markets.
Which brings us to the core protocol itself. Here's where it gets really interesting, because we need to talk about Executive Order 14409.
Right. So the White House quietly ordered federal information systems to transition to post-quantum cryptography, or PQC. And this has to be approved by the National Institute of Standards and Technology.
And what's the timeline on that?
The hard deadline for this key establishment is December 31st, 2030.
Okay, but why does a federal IT mandate matter to Bitcoin?
Well, because Bitcoin relies on legacy encryption, specifically ECDSA and SHA-256. That's essentially the mathematical lock and key proving you own your coins on the blockchain.
Right.
Traditional computers would take millennia to guess your key, but quantum computers operate differently. They calculate massive data sets simultaneously, allowing them to essentially reverse engineer your private key from your public address in seconds.
So the whole network is vulnerable.
Exactly.
Yeah.
Because of this federal mandate, protocol developers and custodial firms are going to face severe, unavoidable regulatory pressure to transition their encryption to post-quantum standards before that 2030 deadline.
Wait, I have to push back on this. Doesn't a strict top-down federal deadline fundamentally clash with Bitcoin's architecture?
How so?
Well, the consensus mechanism is inherently slow and decentralized by design. How does Washington force a decentralized global network to overhaul its core cryptography on a rigid schedule?
The government cannot force the decentralized nodes to change their code, but they absolutely regulate the custodians holding the assets.
Ah, the ETFs.
Exactly. If the Bitcoin network refuses to upgrade its encryption, regulators could simply tell the ETF custodians, this asset is no longer compliant with federal security mandates. You can no longer hold it.
Wow.
It forces the network's hand by threatening to cut off billions in institutional capital. I mean, if you're holding Bitcoin in a hardware wallet right now, you might be wondering how a federal mandate to an ETF custodian affects you. Well, it dictates the security standard of the entire chain your coins live on.
So the asset class is caught in this incredibly tight convergence. You have rapid TradFi integration happening on one side and an impending forced cryptographic overhaul on the other.
And that tension will define the market structure over the next 4 years.
Which leaves you with one final thought to explore on your own. If the network is forced to successfully upgrade to these new post-quantum standards by 2030, what happens to the billions of dollars sitting in early, lost Satoshi-era wallets?
Oh, that's a huge question.
Right. To migrate to a new encryption standard, you have to actively sign a transaction from your old wallet. If the owners are gone and the keys are lost forever, they can never authorize that migration. So do billions of dollars in legacy Bitcoin just get left behind on a vulnerable, obsolete chain? Something for you to think about until next time.